Based on Taylor's and Hertzberg's motivation theory, there are two main ways of motivating workers that can be used by management, especially human resources department. Motivate workers financially and non-financially. Let's discuss in detail each of the ways. Motivating workers financially. This method is done by giving workers financial rewards. Financial rewards include wage, salary, commission, profit sharing, bonus, performance-related pay, and share ownership. Wage. Wage tends to be paid to manual workers, and paid weekly. So, they do not need to wait long for some money. However, it may take time for a business to calculate wage of its workers weekly. Wages clerks are often employed to perform this task. There are two ways of working out wage calculation: time rate, or hourly rate, and piece rate. Time rate is payment for working a period of time. For example, warehouse workers are paid $10 per hour. They work 40 hours in a week. So, they are paid $400 for the week. The advantage of time rate to businesses is it is easy to calculate workers' wages. Workers can also focus on quality. However, the disadvantage is it may take time to calculate the wage based on the time worked by every worker. Another disadvantage is both good workers and bad workers get paid the same amount of money. This does not really motivate workers to work hard and more effectively. Therefore, it does not increase output. So, does not lead to increased productivity. Piece rate. Piece rate is payment for the quantity of products made. The more output workers make, the more money they get paid. For example, a minimum wage for handicraft workers per week is $400, with minimum of 40 pieces of output per worker per week. Workers, who can produce more than 40 pieces of handicraft in a week, can get paid $10 extra for every single extra piece of handicraft they produce. The advantage of using piece rate is that workers are motivated to work faster and produce more output. This leads to increased labor productivity. However, workers may concentrate on making a large number of products, but ignore the quality. This could damage the reputation of the business. To prevent this, a business may employ inspectors to do quality control. This way, however, is expensive, and adds to production costs. Another disadvantage is that workers who are careful in their work will not earn as much as those who rush. This demotivates good workers to produce quality products. Another possible disadvantage is that if the machinery breaks down, workers will earn less money. Because of this, workers are often paid a guaranteed minimum amount of money. Salary. Salary is payment for work, usually paid monthly, and straight into a bank account. It is usually paid to office staff and managers. There are some advantages to a business of using salary. A salary is calculated as an amount of money per year, and is divided into 12 monthly amounts. This is easy to calculate salary costs for the business. The employer has the money in their bank account for longer than if they were paying wages to their workers, as salaries are paid only once a month. Also, the payment is calculated only once a month, instead of once a week, as with wages. The advantage of using salary to workers is that workers know exactly the amount of money they receive every month in a year. This gives them a sense of income security. They can make a plan for the use of the money. However, the disadvantage is that good workers and bad workers get paid the same amount of money. This demotivates good workers to work hard and more effectively. Because of this, other financial rewards are often added to the basic salary to increase workers' motivation. The other financial rewards are commission, profit sharing, bonus, performance-related pay, and share ownership. Commission. Commission is payment relating to the number of sales made. It is often paid to sales staff or salespersons. The more sales they make, the more money they are paid. This is similar to piece rate. Commission encourages sales staff to sell as many products as possible. Therefore, sales are likely to increase. However, if the sales staff are very persuasive, and encourage people to buy goods they don't really want, then the business may see its sales increase only in the short term, and then fall again. Profit sharing. Profit sharing is a system whereby a proportion of the company's profits is paid out to employees. Profit sharing is often used in the service industry, where it is difficult to identify individual employees' contribution to the increased profits, but they will all benefit from more productive work. Profit sharing is likely to improve efficiency. This is because when workers work more efficiently, efficiency increases, costs fall, and profits increase. This method also improves workers' loyalty, or retention. Bonus. Bonus is an additional amount of payment above basic pay, as a reward for good work or achieving a target. It can be paid at the end of the year, or at intervals during the year. Workers can feel recognized if they receive a bonus. However, this increases costs, which a small business may not be able to afford. Workers may be demotivated by unrealistic targets. Giving bonus may only have a short-term boost to motivation. So, any increase in productivity may only be temporary. Performance-related pay. Performance-related pay is pay which is related to the effectiveness of the workers where their output cannot readily be measured. For example, teachers, managers, or health workers. To assess the effectiveness, supervisors observe workers' work, talk to their colleagues, and interview the workers, to discuss their progress and their effectiveness. A method of appraisal is used, to assess the effectiveness of an employee. A certain percentage of an increase in salary is determined by the level of the effectiveness shown in the appraisal result. However, this is time-consuming, and the appraisal results may not accurately assess workers' performance. If less specialized assessors are employed, this may cause conflict among workers. Share ownership. Share ownership is where shares in the company are given to workers, so that they become part owners in the company. This should motivate them to work hard, and more effectively as they will receive dividends if the company goes well. The better they work, the better the company goes, the higher the value of their shares, which results in the greater dividends they will receive. So, this method will also improve workers' loyalty, as they will have a greater sense of being part of the company. However, existing shareholders of a private limited company will lose some control over the company. This method may lead to reduced dividends per share, or less retained profit, as the number of shareholders increases. Another drawback, shares of a private limited company cannot be easily sold. So, workers may prefer cash to shares.